Welcome, everyone. I'm Joe Galvin, Chief Research Officer at Vistage Worldwide. I'm happy to host the latest webinar in our Peak Performer webinar series. This series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community. Experts who provide exceptional insights and best practices, helping you to navigate new challenges and possibilities. Volatility and uncertainty best describe the economic landscape of June 17, 2022. The accelerated disruption brought on by the pandemic has taken us from the good old days of 2019 and before, when steady, slow growth combined with historically low interest rates and low unemployment were the norm, to the rapidly shifting, unpredictable environment we now live in. Today, words like inflation, interest rates, cash flow, cost of gas, hiring, supply chain, retention, workforce wages, price increases, increasing prices, are on the minds of our CEOs, which all leads to speculation of the R word. Whether we're already in a recession or about to enter one, the more important question to ask is how deep and how long. That's why we're so grateful to have our friend, Vistage member and speaker, Dr. Adrian Cronje, CEO of Balentine, a wealth management firm based in Atlanta and Raleigh, back with us again to help sort this out. He holds a PhD in macroeconomics and econometrics from Cambridge. He is a co-author, along with another longtime member, Robert Balentine, of an amazing book called First Generation Wealth, where they provide 3 guiding principles for long-lasting wealth. Now, that's not a problem I'm ever going to have, but I did give this book to my millennial children in hopes that it would help shape their thinking. What I think makes Adrian's perspective so insightful is that he takes a capital markets perspective on the forces driving our economy today and what that looks like into the future. Adrian, it's so great to have you back again. Your timing is once again spot on, and I can't wait to hear what you have to share with us today.
Thank you very much, Joe. Good afternoon, everybody. It's very nice to be back during a very important week in this year. And I'll start with the bottom line up front to get the bad news out of the way. It seems that capital markets this week have moved to price in a likely recession over the next 12 to 18 months. In fact, there's a small chance we may already be in recession. If you look at the Atlanta Federal Reserve's GDP Now indicator, that is a proxy they use to measure the economy in real time, for the second quarter of this year, that indicator is tracking at slightly above stall speed. And remember, during the first quarter of this year, GDP already contracted. So there is a small possibility that come the end of the month, we might have had 2 periods of contracting GDP, which the National Bureau of Economic Research often uses as a guideline to date an economic recession. So with that bad news up front, let's remind ourselves to stay grounded. As President Kennedy said in the early 60s, in any potential crisis, one needs to be mindful of the dangers, but there is always opportunity. In fact, as I've been reminding Vistage audiences for the last few years in advance of this event, recessions create an opportunity for business owners to take advantage of their competitions during a time of stress. So I want to end off this afternoon's discussion with some of the opportunities as well that we can think about as we enter this period of slowdown. So how did we get here? As Joe said at the outset, things have changed quite dramatically. When we last talked, Joe, these indicators were all signaling go, dark green, robust business conditions. When talking to you last, I said be mindful of the potential of inflation. Last year, the buzzword was inflation was going to be temporary. I pointed out that the stimulus that had been brought to the economy in order to bring relief as we went into lockdown was unprecedented. In fact, many economists now estimate that we put 3 times as much money back into the economy as the pandemic took out. Just think about that. That's a rather stunning statistic. And so what started this game-changing period of volatility, uncertainty, is the fact that inflation has become a real problem. In fact, if you look at the 2-year rate of inflation, and I use 2 years because we like to smooth out the effects of inflation to see how much it's accelerating and to take out some of the pandemic effects of 2020, you can see that the CPI 2-year inflation rate has annualized north of 6%, something close to 7%. If you look at the 1-year numbers, inflation at a headline level is running at 8.5%. If you strip out more volatile food and energy, it's running at around 6.5%. So we haven't seen inflation like this since the early 80s. And the real question, as Joe said at the outset, is whether this is going to turn into a protracted period of stagflation. That is a period of high inflation and low growth like we experienced during the decade of the 1970s. And again, for reasons that I will cite in a moment or two, so far capital markets have said that a recession is likely, but that it is likely to be both mild and short, and that a return to the 1970s is not yet on the cards. This chart shows just how pervasive the inflation problem has become. I've looked here at the contributions to the headline inflation rate, not just from food and energy, but look how pandemic-affected services are contributing to the inflation rate, as well as automobiles and other core components of CPI. So it's not just that inflation has become a problem at a headline level, it is broadening out across the economy. And the key question for the Federal Reserve is whether this unanchors inflationary expectations and creates a wage price spiral, which will have to lead them to increase interest rates then even more than the capital markets have started to discount this week. Speaking of capital markets, take a look at how certain speculative areas have already unraveled during this period of volatility and uncertainty. And this chart shows down at the bottom, starting with an index of SPACs, which have fallen by more than 60%, just how some of the speculative excesses that have been built up over the last couple of years have rapidly unwound. Cathie Wood's innovation and disruptive tech companies have fallen by more than 60%. Bitcoin has more than halved. Joe, boy, am I glad that I no longer have to answer the question about whether Bitcoin is the next safe asset class, a better place to invest than cash. Growth stocks have fallen by 30%. Value stocks have fallen by 12%, but take a look at the energy sector. It has actually risen by over 50% on a year-to-date basis. And so the point of this chart is it's very important when investing in capital markets to pick and choose your spots and to avoid areas where obvious areas of speculation are building up. But it also tells us a message about what is driving the outcome, which I'm going to expand upon in a minute. So let's set the agenda for the balance of our time together. Well, I've already given you the answer to the question about whether today's inflation will inevitably lead to a recession in the next 12 to 18 months. I'm going to show you how the capital markets have already drawn that conclusion. There is a small chance that we can avoid the outcome, and I will show you what needs to happen in order for the economy to thread that needle. But the bottom line here is there is a lot outside of the Federal Reserve's control. They certainly can control the demand side of the equation by increasing interest rates to put the inflation genie back in the bottle. But there are other issues facing the economy that they cannot control. And I'll talk a little bit more about what those are. Most importantly, as I've always said when doing these for Vistage, I want to leave you with tools that you can monitor this in real time so that you can have a better forward-looking outlook as to what is likely to evolve rather than to listen to some of the emotion and noise that the financial media traffics in each and every day. They are there to sell us stories and to prey on our emotions. Capital markets are much more logical and rational, and they can be your guide to remain grounded about what's likely to occur in the future. I then, as I said at the outset, want to spend some time, which I've talked about before, but I want to re-emphasize this week especially, about tactics and things you can do in your business today to prepare your business to become a predator, not a prey, during the ensuing economic weakness. And as always, throughout my presentation, I'll be offering you resources and tools for you to double click on certain issues, to dig a little bit deeper on some of the concepts that I'm talking about today, including the book that Joe mentioned at the outset, First Generation Wealth. Robert and I have been humbled by the response we've received from throughout the Vistage network as people have leaned into those 3 principles that we talk about, gleaned from 30 years of advising business owners and entrepreneurs, not just about their business, but life after their business and the wealth that they have created through time. On our website at balentine.com, by popular demand, there is a Vistage web page dedicated to Vistage members. You're able to download all of the resources there free of charge in one convenient stop. So let's get to it. And before I get into the capital market indicators, and I'm sorry if I repeat this over and over again, but again, this episode has reminded you all, I hope, of this truism. Capital markets lead the economy, not the other way around. I spent a long time studying the subject of economics, and I have come to the conclusion during my training as well as my career in investments and wealth management that economists have good theories about how the economy works, but the traditional way of forecasting the future economic environment is very limited because the data that they use in their models of the economy are lagging and often subject to revision. It's a little bit like driving the car down the road by looking in the rearview mirror. This is why I am so passionate about educating business owners and CEOs and CFOs and people who are making decisions in the C-suite to educate themselves on 4 key capital markets, which taken in conjunction give you a far more reliable outlook to the future economic environment. And so let's start with the stock market and remind ourselves that essentially a stock price every day, as a Vistage member facetiously reminded me last week, is an opinion. Yes, it's an opinion, but it's an opinion about the value of a stock or security or a stock market index based on underlying profitability of a company, not just today, but out into the future. There has never been an economic recession without a corporate profits recession occurring, which is why the stock market is such a powerful indicator of the future economic environment. And so when the stock market moves to price in what we call in our industry a bear market, that is a decline from peak to trough of 20% or more, that is a signal from stock market investors that corporate profits are likely to decline and that we should be on watch for an economic recession. Well, this week, the stock market closed in bear market territory for the first time since 2009. And I want to set aside the episode around COVID, where the stock market crashed 30% or more, but quickly recovered again. That is not the cyclical bear market that I refer to as one of the recession's red lights that start to flash in advance of economic weakness. So certainly something to pay attention to. Secondly, I've talked at length in past webinars about the importance of the message from the bond market. And of course, in the current context of inflation and where interest rates are likely to go, this takes on even more importance. Remember, the bond market signal is telling us each and every day, not just where interest rates are going to be today, but where they are going to be in the future. And the relationship between long-term interest rates and short-term interest rates, which we in our industry use the jargon to describe as the slope of the yield curve, is absolutely critical. Normal conditions normally entail long-term interest rates being above short-term interest rates, with the expectation that the economy is going to grow and that inflation is going to be stable and short-term interest rates will rise in order to equilibrate with long-term interest rates. When the yield curve flattens and inverts, that creates a huge headwind for accelerated economic weakness because it affects the profitability of our banking channel. Remember, if you're a bank, you're taking in deposits short and paying for your financing with a short-term interest rate, with the ability to lend long and earn a long-term interest rate. So if the yield curve is positively sloped, that is giving you a tailwind to profitability as a bank and is more likely to lead you to lend to corporations and businesses that we all run as CEOs. On the other hand, when the yield curve flattens or inverts, that creates a headwind to bank profitability and leads them to be less likely to lend to us, to take the risk to invest and hire folks, so exacerbating economic weakness. Many economists refer to the slope of the yield curve as the credit channel of monetary policy, given the importance that banks have in sustaining economic activity. This week, the yield curve dropped through zero briefly and is oscillating around zero. And so a second shoe has also dropped from the bond market, signaling that economic weakness is likely to ensue. There has not been a recession in our economy for the last 50 years without the yield curve inverting first. It is doing so, albeit briefly and not yet significantly. But the bond market is also starting to price in a likely recession that is going to be mild and short in nature. Thirdly, the credit markets are typically the third shoe that drops when recession's red lights flash. Credit spreads are important because they're a proxy for optimism in the corporate sector. If you think of CEOs and CFOs of large corporations, you have the ability self-evidently to go to the bank to borrow money in order to grow your business, but you also have the ability to tap corporate bond markets in order to optimize your capital structure. And the premium at which those corporate bonds have to charge an interest rate over the safe treasury bond rate gives a very good sense of corporate bond investors' views into the future. Typically, as I've said before, that premium is around 5 percentage points or 500 basis points. And so when spreads for corporations are tighter than 500 basis points, that normally reflects optimism, low default rates from corporations. Whereas when it crosses the 500 basis point threshold, that is another signal from the capital markets to be put on notice that ensuing weakness is on the way. And of course, this week, those corporate credit spreads crossed the 500 basis point mark for the first time since the lockdown of 2020. So as I'll show you in a moment or two with some charts and updated indicators, all three of those indicators, the stock, bond, and credit market, have moved from dark green through yellow to a pale shade of red. Lastly, pay attention to the commodity market. And I know many of us within Vistage are not managing businesses that do business abroad, but the health of the global economy, and especially countries like China, Russia, India, and Brazil, that produce and consume so many commodities, are an important indicator of how healthy the global economy is. We are still by far and away the most robust and diverse economy in the world, but we no longer produce the majority of global GDP like we did when we entered the 2008 and 2009 crisis. That belongs to the basket of developing countries that I've just referenced. And so the price of industrial commodities, think copper, think zinc, iron ore, nickel, and so forth. I'm not talking about precious metals like gold or oil, really give you a real-time temperature check on the health of the Chinese economy. You know, I often get asked about how strong or weak the Chinese economy is, especially in the context of the deteriorating strategic relationship between the United States. And my answer to that question is, I'm not sure. One can't trust the statistics, but take a look at the commodity markets. And so when the price of copper, which has actually become known as Dr. Copper for its forecasting prowess of the global economy, moves into bear market territory or a 20% decline, that is a sign of weakness in those economy and should put us on alert that the global economy may be weak and we may be importing weakness from abroad. So the message is as follows: capital markets lead the economy, not the other way around. These forward-looking 4 indicators are much more useful to you all as a guide to the future. Use them in conjunction with each other, not in isolation. As Paul Samuelson quipped about the stock market, pay attention to the stock market because it is such a powerful indicator of the future economic environment. But be wary, it can be a little emotional, for it has forecast 9 of the last 7 recessions. In other words, there can be a corporate profits recession without an economic recession, which is why I encourage you all to use these markets in conjunction with each other. By the way, you can track each of these indicators on your phone in real time. And if you would like to do that, please send me an email and I'll be sure to follow up. As I've said to Vistage audiences for the last years, I'd far rather than be tracking these 4 capital market indicators on their phones than individual stocks. But before we look at some charts, I just wanted to remind you of what these indicators looked like at various points in time over more than the last 20 years. We've been viewing the capital markets through this process for over 20 years. And in the first quarter of 2000, they were flashing red, signaling the economic recession in the early part of that decade. That was precipitated by the stock market crash and then exacerbated by 9/11 and so forth. Similarly, in the second quarter of 2007, the first 3 indicators flashed red. The only one that gave a contrary indicator was the commodity market. Remember, at that time, all the rage was the story about the Chinese growth miracle and how that would continue to grow the global GDP. And I remember in 2007 how people were crafting the narrative that one needn't worry about the inverted yield curve at that time from the bond market, because this time was different. As they say, some of the most dangerous words in investing and managing a business, this time is different. I show you how here in the first quarter of 2019, when I first started talking to Vistage audiences about the power of these indicators, that actually they kept you in the game that year. There were a lot of traditional economic forecasters who were saying that 2019 was inevitably going to lead to a recession because the economic expansion was in its 10th record year. As I reminded audiences at that time, economic cycles are not divinely ordained to die of old age. Capital markets will tell you on a forward-looking basis when instability occurs and interest rates have to rise to a point where a recession occurs. And so 2019 turned out to be a pretty robust year, which just highlights again how important it is to look at these indicators and stay above the emotional fray and to avoid being overly faked out by the negativity. And then as Joe and I led you through several webinars during and in the immediate aftermath of COVID, they flashed red overnight, but just as importantly, went back to green overnight in the second quarter of 2020, signaling that the balance of 2020 and 2021 was actually going to be a robust period of economic growth, which again, I think profited business owners that were contrary to some of the prevailing pessimism in the immediate aftermath of the pandemic. So how can things change so quickly from dark green to, a mild shade of red across the board? Well, here's what happened. The Federal Reserve got faked out, and then 2 events occurred that occurred beyond its control. Let's talk about the former. As you know, in March of 2020, Jay Powell, current chairman, stood up and said, "We've learned from our mistakes in the past, in particular the mistake we made in 2008 and 2009 as the economy moved into the great financial crisis. Our response was too little, too late, and incoherent. This time we are going to go big or go home, because the unexpected event is not that we have a pandemic. After all, we've had those before. The unexpected event was that we are going to put the economy in lockdown in order to contain the spread of the virus so that it didn't overwhelm our healthcare system. So we are going, before markets open after the lockdown, to drop interest rates down to 0. He literally said we are not going to think about raising interest rates before 2023. And what's more, we are going to use our weapon of choice in order to provide liquidity to markets to combat some of the uncertainty. And so we are going to use our balance sheet to buy bonds, not just treasury bonds this time, but the bonds of any sector in the economy where there's likely to be distress, such as municipal bonds for state and local authorities, such as corporate bonds. implicitly recognizing the third indicator here that I've highlighted for you to take care of. And they allowed their balance sheet to expand from $4 trillion to a little north of $9 trillion earlier this year. The money supply was growing at 25% throughout 2021, just enormous stimulus. And of course, the economy recovered, as these indicators said, and attained their pre-pandemic levels far sooner than consensus suggested. But they were reluctant to tap the brakes because about this time last year, we were dealing first with the Delta variant of the pandemic, and there were questions whether the economy had to go back into lockdown. And just as that resolved itself, we then had to deal with the Omicron variant during late last year. And so the Federal Reserve, what now looks like, made a policy mistake in not removing the punch bowl from the party before it got started soon enough, because it was faked out about the course of the virus. And as soon as we realized that the Omicron variant was, in the view of epidemiologists, one step closer towards the pandemic becoming endemic, and that widespread lockdowns was not going to be a policy tool anymore, people woke up to the fact that the Federal Reserve might be really behind the curve in normalizing monetary policy. And then two things happened that was beyond its control. First, China took a different view on dealing with its pandemic and put its country into lockdown earlier this year, so shutting the port of Shanghai, so exacerbating some of the supply chain bucklings that a high-pressure economy was already experiencing. And then, of course, there was the tragic war that broke out in Europe for the first time in several decades, putting additional pressure on inflation. Many of the commodities that the country of the Ukraine produce are actually important intermediate inputs into final commodities that are so critical for us to grow crops. And so many people are already studying the potential for a crisis in the supply of fertilizer and food shortages across the world as a result of the protracted war that could lead to inflation remaining stubbornly high. So the point being, they made a policy mistake, and then two things buffeted the economy that they could not control. And so, unfortunately, the very small possibility that we can escape a technical recession lies through the fact that supply chain disruptions have to ease, and the war in the Ukraine needs to end in order for some of the supply side causes of inflation to dissipate. Incidentally, the resource that I'd like to call out here is Are Recessions Red Lights Flashing? I authored that article in 2019. And if you pull that off of our website, it goes into each of these indicators and how they work in greater detail. So let's take a quick detour through some charts to take a look at where the markets are currently at and where they have come from. And that will help answer the clue as to how severe and how long this period of downturn is likely to be. Let's start with the stock market. And Joe, I know this is a bit of an eye test for viewers, but again, this chart can be requested via our website. Our team actually produced this chart earlier this year in anticipation of some of the volatility that we were going to experience. And it looks at the performance in the top of the S&P 500, the basket of the largest S&P 500 stocks, going all the way back to 1928. And in various shades of gray, where there's been a structural bull market, or in red, a structural bear market. So the difference between a structural bear market and the cyclical bear market we're in today is structural bear markets last for years and decades, where the stock market takes a long time to recover its previous peak. You can see there in the 1970s, for example, a protracted bear market in stocks. In fact, there was a famous article in 1979, I believe in Business Week, that heralded the death of the stock market or the death of equities, again speaking to how important it is not to succumb to emotion and the hype that the media traffics in. But down at the bottom, you'll see 108 instances of reasons to sell the stock market, including reasons like the Second World War, or a Great Depression, or a assassination of a president. lots of reasons, the Cuban Missile Crisis, to bet against the stock market. Warren Buffett likes to quip that a lot of people have bet against America and lost a lot of money as a result. Or as my hero Winston Churchill likes to say, America always does the right thing eventually once it's exhausted all of the alternatives, right? And so the point here is this too shall pass. And as I've said over and over again over the last few years, the best way to prepare for a recession when investing is to make sure that you have ample liquidity to endure the average length of a cyclical bear market, which is 18 months to 2 years. That way, you never have to sell assets at depressed prices, so permanently impairing your capital. And so when we advise clients, we are always thinking strategically about what cash levels to have so that they can endure the average length of a bear market, so that they can use some of the volatility that we are seeing today as an opportunity to lean in to some of the distress sellers that there are out there. That mindset should be the same for you as a business owner. Take that mindset to thinking about how to pivot, having prepared for ample financing during an economic weakness to take advantage of your competitors' stress. It also speaks clearly, I think, to how important corporate profitability is to the economy and the future economic environment. And I'm going to get to that point in a minute, but I want to draw your attention to a signal that the stock market is showing us if you dig a little bit beneath the surface. And I think I first talked about this slide during our last webinar, Joe, but this really traces the performance between so-called growth stocks and value stocks. If you think about the universe of the Russell 1000, which is the largest 1,000 stocks in the United States, which stocks have consistently grown their top and bottom lines and therefore demand a premium multiple, growth stocks, versus those stocks that are trading cheaply relative to underlying fundamentals and are likely to do well through multiple expansion value stocks. And you can see going all the way back to 1979, that areas in red is where the basket of value stocks have outperformed the basket of growth stocks. Areas in sort of dark blue is where growth has outperformed value, and green have been periods where this tug of war has ended in a stalemate. This is a profound chart because I don't think people really appreciate just how extended periods of outperformance between growth and value are and how wide the amplitude can be. Just take a look at the period from the late 1990s all the way through to the mid-2000s and how value outperformed growth. I remember in 99, a few years after I started my career, people dismissing Warren Buffett, who invested in value stocks, as having lost his mojo, right about the point when the tide turned and growth severely underperformed value as technology, media, and telecom stocks crashed. You can see how in the years leading into COVID and during COVID, growth really outperformed value. So being on the right side of that trade has been a really important part of portfolios as COVID accelerated many underlying trends. But take a look at how value has begun to outperform growth since 2021. We may be on the dawn of a new bull market in value stocks. And that's an important thing to get right if you are a stock market investor. But the more important thing for you as a business owner to realize is that is signaling that we are in for a protracted period of interest rate increases and inflation. And the reason for that is so much of the value of growth stocks actually lies in the outer years of profitability, which now have to be discounted back at higher interest rates. And so as interest rates rise and as inflation persists, there's huge headway to growth stocks and a huge tailwind to value stocks who are returning capital to investors more quickly in the form of dividends and buybacks, which can be reinvested in higher rates. So not just the overall level of the stock market, which this week closed into a cyclical bear market. If you dig a little bit deeper, it gives you a real sense of what the issue is behind what's causing a bear market in aggregate. I want to also remind you all of something I've been talking about as well, which is productivity growth is something for us all as Vistage members to educate ourselves on. Key to corporate profitability hanging in there as the cost of capital and interest rates rise is the ability of all of us to do more with less, become more efficient. This chart looks at labor productivity growth in terms of GDP per hour. And it's unfortunately a lagging indicator, but you can see how productivity growth really started to increase after 2017. The Tax Cuts and Jobs Act of that year, passed by Congress, was explicitly designed to try to stimulate productivity growth by getting corporations to invest more in the future and to take risk by lowering corporate tax rates and so forth. COVID accelerated many trends that businesses were already adopting and using technology to do things more smartly. It's not just virtual communication, it is automation, it is artificial intelligence, it is the blockchain underlying the Bitcoin application to the protocol. That has helped the digitization of the payment system. There are all sorts of reasons to think that productivity growth could really help any weakness be short and shallow, because it will allow corporations to continue to be profitable, which again will allow the stock market not to have to correct much further. So this is something that we are thinking deeply about in real time. The analog today could be to what the economy experienced 100 years ago, the roaring 20s, where innovations like electricity, the automobile and aviation really led to a decade of very robust economic growth, punctuated by short periods of weakness, even at high levels of inflation, but a long period of strong growth. So, that is one factor to take into account as we think about how extended or how sharp the economic downturn is likely to be. Here is the slope of the yield curve going back to 1986, and you can see clearly in areas circled in red how the yield curve inverts in a sustained and significant way 12 to 18 months in advance of recessionary periods denoted in gray. On the right-hand side, I've circled the brief inversion of 2019. That was not the bond market correctly predicting that COVID was coming. That was the bond market signaling a yellow to red sign, as I showed you in an earlier slide, about their concern at that time that the Federal Reserve was raising interest rates too quickly, given the accelerating trade war that was being prosecuted in 2019. And you can see how sharply the yield curve turned positive as the authorities, the Federal Reserve, really monetized some of the fiscal stimulus that was brought to the economy's relief in the lockdown period, and how quickly it has lost its slope since 2020. You'll remember me talking about the very significant monetary policy announcement from Jay Powell back in the summer of 2020. Notice how the slope of the yield curve really accelerated after August of 2020, where he at Jackson Hole announced that there was going to be a new approach to monetary policy, recognizing that they had thrown a lot of money at the problem to go big or go home this time, so that they didn't underreact like they did in 2008. He said, moreover, we've persistently fallen short of our inflation target, so this time we're going to let the economy deliberately run a little hot, so that the average rate of inflation could reach our target of 2%. Remember, the Federal Reserve has a dual mandate set by Congress: stable inflation, which they argue is a core rate of inflation of around 2%, and full employment as well. And he said, this time we're going to let it run a little bit hot. And so we are not going to remove stimulus until we literally see the whites of inflation's eyes. And of course, that set them up to get faked out by 2 rounds of COVID last year, and then 2 things that went out of their control, which the Chinese lockdown and the Ukrainian war speak to. So today, that's a little bit above zero, and something certainly to take into account. I often get asked, about interest rate expectations. And so this resource might be very helpful to you as business owners. You can use this FedWatch tool in real time, available at the cmegroup.com's website. This is known as the dot plot. It really signals every voting member's input on the Federal Open Market Committee, the FOMC. They get to vote on interest rate policy at the Federal Reserve as to where short-term interest rates are likely to be in 2022, 2023, 2024, and the longer run. You can see in median light blue where expectations are. As of yesterday, to bring this dot plot up to date, the Federal Open Market Committee is expecting short-term interest rates to be as high as 3.4% by the end of this year and by 3.8% at the end of next year. So we still have a long way to go in terms of short-term interest rate increases, let alone some of the decisions that they are making to their balance sheet in order to remove some of this record stimulus and to make sure that inflation expectations remain under control. And I'm going to get a little academic on you here, Joe, so bear with me. And so this is a relationship economists like to call the beverage curve, and you probably need some form of strong beverage to try to wade through it. You can see the resource listed at the bottom if you want to track this in great detail. So this is one of the reasons why capital markets have convinced themselves that a recession may be on the cards, but that it may be short and shallow. The beverage curve tracks the relationship between job vacancies on the vertical axis and the number of unemployed people on the horizontal axis. And you can see the long-run relationship looks like a gentle smile. You can see in the post-COVID years towards the top left-hand side of that chart just how much steeper the relationship or the trade-off between vacancies and job growth has become. There are 2 job openings today for every unemployed person in the United States, 1.9 million vacancies to around 1 million people unemployed. The economy, for all the reasons that Joe, you and your webinars have discussed, has really not been very efficient in matching people looking for jobs with the jobs that are available. That is a subject for another time. The normal relationship is that there are normally 2 people looking for every 1 job that is available. And so the capital markets are handicapping the likelihood that this gives the Federal Reserve lots of runway to catch up to where they need to be by raising short-term interest rates, because it's not going to cause as sharp an increase in unemployment as past interest rate increases have done. And so this is something also to educate yourself on. Remember, I said the path of productivity growth is going to be key to how long and severe the economic weakness is going to be. Whether this is the case that interest rate increases is actually going to destroy more vacancies than lead to more unemployment is also a reason to conclude that the recession might not turn into something as severe as we experienced in 2008 or in the early 2000s. So I hope that was a helpful explanation. But when you see Jay Powell read the minutes and refer to the beverage curve, this is what he is talking about. And so far, capital markets are really dialed into that particular dynamic, because what is essentially at stake is whether some of the wage inflation that we have experienced over the last few years, which is now running in aggregate north of 5%, doesn't lead to a self-reinforcing cycle of inflation falling out of control. As business owners, as I said to my partners yesterday, perhaps this gives us a chance to reset relationship with employees. The challenge of hiring and retaining employees during and after COVID has been well documented. Perhaps this period of economic weakness will help to reset this labor market and allow us to find it more easy to hire and retain workers at more reasonable levels. Here is the chart of the credit spreads. Remember, I said 500 basis points in red over the safe treasury bond is the yardstick you need to keep an eye on. In light blue, you can see that the broad high yield credit spread market has breached that 5% level as of this week. You can see in dark blue the energy sector. I call that out just to remind you that much like digging beneath the surface in the stock market on value versus growth, if you look at credit spreads across various sectors, you can use this to understand why certain areas are being affected more during economic weakness than others. And you can see how much tighter the energy spread has been. As I showed you in the chart at the outset, the boring old energy sector, which was left for dead twice on COVID. We can remember the days when the oil price traded negative. Now that it is over $100 and some people expecting it to be $150 a barrel during the peak summer months. As recently as November last year, the market capitalization of the entire energy sector was less than the market capitalization of one technology stock, Apple, which goes to show how the energy sector was left for dead, but how well it has done in the ensuing market volatility. Finally, the commodity market index. Again, I'm stressing the industrial metals. You can see how far it has corrected recently, and that speaks to concerns about Chinese economic weakness as it remains in lockdown. I'm not talking about precious metals in light blue, which is gold and silver, so keep an eye on that final indicator. And as I said at the outset, unfortunately, we've gone from dark green in the fourth quarter of 2021 all the way to a mild version of red. So, in summary, the chances of a recession are as high as 50% over the next 12 to 18 months. In the capital markets view, it is now the base case as of this week. Unfortunately, the outcome depends not just on the Federal Reserve. Supply chain disruptions have to ease. The lockdown in China has to end so that it can return to normal economic activity, and the war in the Ukraine has to subside. The potential for productivity growth is underappreciated. That could allow corporations to continue to crank out profits as the cost of capital rises. Pay attention to that beverage curve in the labor market. That will also give you a sense of how extended and deep this recession is likely to be. If interest rates can continue to get to that 3.4% level and the Federal Reserve can shrink its balance sheet without causing rapid unemployment, that would argue for a typical mild recession of around 6 to 9 months. And here are some of the developing themes that capital markets are now starting to digest. Just how flush consumers are from all the stimulus. Consumer balance sheets today, as a result of all the cash that's been injected into the system, are far stronger than they were when we entered the 2008 and 2009 financial crisis. Our banking system today is far better capitalized as a result of the regulations that were implemented after 2008 and 2009. So tier one capital ratios are north of 10% for our banking system, which will allow it to absorb more losses from economic weakness than it did in 2008 and 2009. And so the signs today are that the recession is not going to become a systemic issue. I will point out that the unraveling of the crypto markets is worth something keeping an eye on. That has really unraveled, and some corners of the market are already experiencing illiquidity. And then, as I said, corporations are entering this period of weakness after having years of bumper corporate profitability. So their balance sheets are strong. And some of the medium-term consequences of this economic period of weaknesses are: what knock-on effects are there likely to be in the emerging world? Just how weak are those economies? If the US goes into a mild recession, what are the knock-on consequences for weaker economies like China and Brazil and Russia and India? That could become an area that could be more systemic in nature for the global economy. Of course, recessions, as is well documented, have influences on political outcomes. We have midterms later this year and a presidential election in 2024. Recessions are never kind to the incumbent party. And of course, as an investor in capital markets, this is where we really earn our stripes. As I said at the outset, we need to be mindful of the dangers, but lean into the opportunities. and recessions are some of the best times to take advantage of your competitor as a business owner. Some of the best businesses are formed during recessions, but it's also, provided you have had your liquidity needs preserved, as I mentioned a moment ago, a very, very exciting time to invest as capital markets adjust. So I hope that you can be prepared using these indicators to be a predator, not prey, whether you're managing your business and investing. And so I have mentioned some of these tactics before as it relates to your business specifically. Before we wrap up and answer some of your questions, which I'm excited to turn to, I want to remind you about how important it is to position your business to be agile and to be resilient. In times of distress, think about how decisions are made, how you can make them quickly, how they can be made informed by the data. Think about how resilient your business model is. Think about ways in which you can turn revenue into recurring revenue so that you don't have to keep making another sale as the economy slows. We've talked at length about how many companies today have pivoted from a just-in-time to a just-in-case mentality when running supply chains. It is no longer the case that profitability is underscored by inventory running just in time. As a result of that, many businesses are running higher than average levels of inventory today. And so I want to underscore the point of just how important cash flow management is in the coming weeks and months as the economy slows down. We have built inventories to prepare for just in case they experience a disruption. But as we hold on to them, that can really eat into working capital, especially for capital-intensive businesses. We have talked about the need to educate ourselves around the impact of some of this game-changing technology that could really enhance our productivity. And I want to end off with just how important two things are. Many people are preparing their business for the ensuing economic weakness by laying off workers. I think that could be a mistake. I think we have learned just how hard it can be to hire and retain great people, especially in an inflationary environment. My counsel has been to businesses to think more about raising prices using the aerial cover of high inflation to do so than to lay off workers if they can. As the labor market resets, that will give you a better chance to enter the recovery from a position of strength. The tactics of using culture and other things such as flexible time has really been a long lesson that COVID has taught us all. But I'd far rather see people continue to try to find reasons to raise prices on their customers than laying off workers, because the recession so far looks like it's going to be mild and short in nature, and the war for talent is just so hard to fight. Vistage, as you all know, provides a lot of resources around these topics. I'd encourage you to look at the CEO Confidence Index each and every month that Joe has done such a great job of assimilating, but also some of the research that is published on the Vistage website, especially around the Inflation Resource Center. There are tons of resources that speak to many of these tactics about how to prepare your business to be a predator, not a prey. They've been very valuable to me as a Vistage member. And so I hope that was helpful. I'll end off before handing it back to Joe by reminding you about our resources. I'm often asked when doing these speaking engagements about how to invest money. And my answer to that question is always, I don't know, because I don't know your context. Investing or giving recommendations about investments without knowing your individual goals is an accident waiting to happen. So I did author Balentine's Investing Cardinals during the COVID lockdown in homage to Vistage legend Red Scott's Business Cardinals, 15 tried and tested axioms that we have used at Balentine for over 30 years in navigating capital markets. We've seen these recessions and cycles before around philosophy, strategy, and implementation that you can use in your own circumstance successfully over time. And that's available on our website by request. Our book, as I said at the outset, has been met with a very encouraging response. I had a friend say, it's a real challenging read, Adrian. I appreciate it, and I was worried that we had written it too academically. But what he meant to say is it's made me think so much that I've had to reread it several times. And so, you know, we are all so mired in birthing our baby as Vistage members and thinking about our company each and every day that we often don't take the time to step back and be introspective and ask some key questions about what it is all for so that we can prepare ourselves for a successful transition. So take a look at firstgenerationwealth.com and you can buy the book there. And I'd be delighted to answer any questions that you might have about our 3 guiding principles. And then, of course, our website has a host of resources dedicated to Vistage members. So, Joe, I've said a lot. It's always a privilege to be back with you all. I'd be delighted to answer any questions that might have come in during my comments.
Well, Adrian, you certainly gave us a lot to unpack. You covered a lot of ground. You provided perspectives and insights that are just really amazing and unique. And I just wanted to test on a few topics because what you said is that there's a high likelihood that we'll enter into a recession in the next 12 to 18 months, but that it will be mild and short in duration.
Yes.
But you also said we should expect to live with higher interest rates and higher inflation, meaning that interest rates will continue to go up and inflation may peak and come down, but it will settle at levels well above as a norm as compared to 2019 and before.
Yeah, I mean, I think that's right. And again, the way you square that circle, which is through 2023 to have higher levels of interest rates and inflation and a short and shallow recession, is productivity growth arrives to help corporations continue to be profitable, even as interest rates and their cost of capital is high, and even as inflation eats in or makes it more expensive on their inputs. And the other way in which you square that circle is that chart that I showed you of the beverage curve, which is the labor market is unusually tight in the immediate aftermath of the pandemic. And so a lot of the pressure in the labor market will be taken out by vacancies going down as opposed to people losing their jobs, which will cause a more protracted and severe downturn. So those are the 2 key dynamics that square the circle between elevated inflation and interest rates through 2023 and a short and mild recession.
We've seen a cooling, if you will, of the talent wars, maybe a truce or a short-term basis. It's cooled a bit, but still we've seen over 50% of our community have added headcount just this year.
Yes.
Another 52% plan to increase headcount in the year ahead. So it kind of speaks to the old Ronald Reagan joke, right? A recession is when your neighbor loses his job.
Yeah.
When you lose hers. Well, no one's losing their job unless they're in the crypto space right now.
Yeah.
But is that one of the things we need to look for is when companies start to lay off? Now, you mentioned we fought these talent wars so long and so hard, it's really hard to give up people that we've hired. But is that going to be a signal this is going to be longer and deeper? Or when that talent war heats up again, does that mean we're back in the game?
Look, if the unemployment rate across the board, not just in distressed areas like the crypto industry, starts to tick up, capital markets will begin to signal that we're in for a longer slog, and a more protracted economic adjustment. But, I get the sense that smart companies, I'm doing this in my own company. I've learned this from a Vistage member in my group over the years. He said to me 5 or 6 years ago, one way in which you prepare your business for a recession is to charge your employees by identifying a counterpart in their position at your competition, and to start to cultivate those relationships now so that when the competition suffers stress during a recession, you have an open door with a great culture and great set of benefits to welcome them. And, that's a tactic that we're deploying in Balentine today. So, that's a very tangible way of using economic weakness, in my opinion, to take advantage of your competition stress.
It's definitely playing the long game, and there's no question that while it may not be as white hot as it was, it's still an active issue. Adrian, I would love to just talk to you for the rest of the afternoon, but unfortunately, we need to bring this to a close. again, I want to thank you so much for not just being part of the community, but your willingness to share this amazing insight that you have with our community, the work you do, both as a speaker and as a member. And it's always such a learning experience to spend time with you. So thank you so much for your time and efforts today.
Well, I appreciate it very, very much. Vistage, joining Vistage was the best decision I made as a business owner. My partner, Robert Balentine, encouraged me to do that 12 years. I've got so much out of it. The fingerprints of Vistage and the speakers and resources are all over our company. It is always a privilege to spend time with you all. And I know my message today might not have sounded especially upbeat, at least as compared to my more recent talks, but I want to leave you with this quote. Recessions provide an opportunity for you to prepare your organization to take advantage of the competition in a time of stress. Recessions and economic weakness should be embraced just as we embrace robust periods of economic growth. The best way to arm yourself for that mindset is to use forward-looking capital market indicators about the future, rather than listening to what economists and strategists have told you about where the economy is at and has already been. So I love to spread this message. I'm available at any time to help a Vistage member. Please just send me an email, and I hope the resources were helpful to you all. So thank you, Joe. I hope you have a great summer.
Dr. Adrian Cronje, CEO of Balentine, longtime Vistage member and speaker. Thank you again, sir.
Well
And
done.
for those of you who were tuned in today, we'll be sending a link to today's recording and the slides within the next day or so, so keep your eyes open for that. We'd also invite you to check out more of our upcoming webinars, including July 15th, Friday, July 15th, Culture as a Strategic Competitive Advantage. Friday, July 22nd, Even a Duck Can Drown, 6 lessons for improving employee wellness and resilience. Friday, July 29th, Market Volatility, Rising Rates, and Recession, Asset Protection for a Down Cycle. You can register for all of these at vistage.com/webinar. That's vistage.com/webinar. Please also plan to join us for one of our upcoming virtual events. Friday, June 24th is our Vistage Women in Leadership Conference. It's a full-day event hosted by my colleague, Ann Petrick, and it has a really dynamite perspective on women in leadership. Friday, July 8th, we will be releasing to members and members only the Alan Mulally conversation with Sam Reese on leading transformation. It's a really powerful discussion with both some of the timeless principles that Alan supports, as well as some great new insights. Vistage members can find information about all these events on My Vistage under the calendar tab. I'm Joe Galvin, Chief Research Officer for Vistage. Thank you for your time today, and be well.